Welcome back to Intermediate Accounting. For today, we will be talking about dividends. First, what are dividends? A dividend is the distribution of some of a company's earnings to a class of its shareholders as determined by the company's board of directors. There are three important dates that we have to remember in accounting for dividends. For example, we have here a resolution wherein the Board of Directors at their meeting on November 15, 2019 declared an annual dividend on ordinary share of 5 pesos payable on January 30, 2020 to shareholders of record at the close of business on January 15, 2020. So again, we have to remember three important dates. We have the date of declaration, the date of record, and the date of payment or distribution. So what will be these dates? So for the date of declaration, or the date when the dividends are being announced, that will be November 15, 2019. The date of record is January 15, 2020, which is the date on which the stock and transfer book of the corporation is closed for registration. So only those who are listed as of this date are entitled to receive the dividends. And 3, we have the date of payment or date of distribution, and that is on January 30, 2020. This is the date when the dividends declared will be paid or distributed to its shareholders. So there are different forms of dividends. First, we have the cash dividends. So these are dividends that are receivable in cash, and they are recorded or recognized as dividend income at the amount of cash received or receivable. So to record a cash dividend, we debit dividend receivable and we credit dividend income. When we already receive the cash payment, we debit cash and then we close the dividends receivable. Another form of dividend is the property dividend. So these are dividends in the form of property or other non-cash assets. The same with the cash dividend, a property dividend is recognized as a dividend income. However, this time we have to use the fair value of the property received in order to record the dividend income. So the journal entry to record the property dividend would be debit to non-cash asset. It could be an inventory, a building, a machinery, or other forms of non-cash asset, and we credit dividend income. For example, ABC Company holds 10,000 shares of XYZ Incorporated as investment in equity securities. On April 1, 20X1, ABC Company receives inventory with a cost of 130,000 and a fair value of 120,000 as property dividend. So in here, what ABC Company receives is an inventory with a cost of 130,000 and a fair value of 120,000. As we have discussed in the previous slide, when we record dividend income resulting from a property dividend, we should record the property at the fair value of the property and credit, of course, dividend income. So our journal entry on April 1 would be debit inventory 120,000 and credit dividend income 120,000. So another example would be, you have on March 1, 20X1, X company distributes its holding of 10,000 shares in Y company as property dividend. So the shares of Y company have a market value of 100 pesos per share. So let's look at the given situation. So X company is an investor in Y company. And how many shares does X company own in Y company? There are 10,000 shares. So therefore, this 10,000 share is an investment of X company. Okay? This time, si X company ang ipapamigay niya ng mga dividends doon sa kanyang mga shareholders ay ang kanyang pagmamayari na 10,000 shares sa isang kumpanya which is Y company. Why is this under property dividend? Because these 10,000 shares owned by X company in Y company are part of its assets. And 'di ba, pag asset siya, that is a property dividend. Okay? Especially this is a non-cash asset. So, ang ipapamigay ni X company sa kanyang mga shareholders ay ang kanyang ownership of 10,000 shares in Y company. For example, a shareholder will receive 500 shares of Y company as a property dividend from X company. So how does the shareholder record this property dividend? Remember again that in recording property dividend, we're going to use the fair value of the property. So therefore, on March 1, the shareholder will debit the investment in equity securities in Y company, 50,000. That's 500 shares times 100 pesos fair value, and credit dividend income. So as you can see here that instead of receiving cash, 'di ba, ang na-receive ng shareholder ay yung investment. Okay, so this time, since natanggap niya yung investment, siya na ngayon ang investor in Y company. So this is, again, another form of dividend, which is in terms of property. So another form of dividend is a liquidating dividend. However, this differs with the first two because this is not recorded as dividend income. Okay, so again, this is not a dividend income. This is just a return of capital, which means that your investment would be reduced or deducted with the amount of the dividend. And this dividend is normally received if the company is undergoing liquidation. And then what is a liquidation? It's the winding up of the business affairs. So what happens in liquidation, you need to sell your non-cash assets, convert them into cash, and then you have to pay for all the obligations, liabilities of the company. If there are any excess money, then you distribute that to the owners. And it also involves a wasting asset corporation. So a wasting asset corporation is involved with the use of the natural resources, like when you have to extract oil. Okay, that is oil like gasoline oil from the natural resources, then that is a wasting asset corporation. Okay, so as an example, you have a shareholder received a 100,000 dividend designated as income, and you have liquidating dividend, which is 40,000. So out of the 100,000, you have 60,000 as income and liquidating 40,000. So how do we record this one? So the first 60 is recorded as a dividend income, and the remaining 40 is a deduction from your ownership. So ownership of your investment or investment balance. Okay, so you have investment in equity securities, 40,000. So the fourth form of dividend that a shareholder can receive could be share dividends, or it could also be called as stock dividend or a bonus issue. So these dividends are in the form of the investees' own equity shares. So let's go back to the previous examples. If you can recall, we have illustration wherein the company is distributing shares in another company. But in this case, the share dividends what the company is distributing to its shareholders are its own shares. So for example, if I am the company na mamimigay ng dividend, yung ipinamimigay kong dividend ay hindi yung shares na pagmamayari ko in another company, hindi. What I am distributing to my shareholders are my own company's shares. Yung binibenta naming shares, instead na ibenta namin sa labas or sa other companies or other interested na buyers, dinis-distribute namin doon sa own namin na mga shareholders. Okay? So this dividend is not revenue because there's no asset being distributed. What we are distributing here are the shares. If you can recall in the previous, the type 2 dividend, which is the property dividends, remember that what we were distributing that time is what I own in another company. And diba, what I own in another company is my asset. But here in number 4, what I am distributing to my shareholders are not my asset, but these are my company's shares. That's why it's not considered as a dividend. So the share dividends could be arising from the unquoted equity securities, or it could be from securities that are measured at fair value. Through profit or loss, or it could be through OCI. So the first one here is from unquoted equity securities at cost. Again, share dividends are not dividend income, and these will be recorded only by means of a memo entry. And how do we write a memo entry for this one? For example, you have to write receive 2,000 shares representing 20% stock dividend. So stock and shares, they are just the same. On 10,000 shares, 10,000 original shares held, shares now held is 12,000 shares. So how do we get the 12,000 shares? So that's 10,000 times 20%. Okay, again, 10,000 times 20%, that would be 2,000. And of course, 10,000 plus 2,000, that is 12,000 shares. Or simply multiply this 10,000 by 120%. Okay, you will get 12,000 shares. Okay, sorry for the handwriting. So the share dividends that will be distributed could be from the same class or same type of shares, or it could also be from a different class or a different type of shares. For example, what I originally bought in the company are ordinary shares, and then I received also as dividend, share dividend are ordinary shares. So that is from the same class. Ordinary yung investment ko, and then yung share dividend ko is ordinary din. What we mean by of different class or from the different class, for example, ordinary shares yung nabili kong shares, but what I receive as share dividend is preference shares, so that is different class. What we'll be talking about in this slide is of the same class. So for example, a shareholder owns 10,000 shares at 120 pesos each, and then the shareholder receives a 20% stock dividend. So just multiply 20% by 10,000, so there will be additional 2,000 shares. What happens in a share dividend is that you only increase the number of shares, pero yung total pa rin na value nung lahat ng shares before and after is the same. It's still 1,200,000. So how does this being accounted for? So for, original shares is 10,000. Total cost is 1,200,000, and then you have the stock dividends of 2,000, which is 20% again of 10,000. That's 2,000. Again, total cost does not change. However, the number of shares now has increased. So how much would be the cost per share? So that would be 1,200,000 divided by 12,000 shares. So the new cost per share would be 100 pesos. So assume that 1,000 of the shares are subsequently sold at 150 pesos per share. So out of the 12,000, yung 1,000 binenta. Okay? So how do we record that? First, we record the proceeds. That's 1,000 shares times 150. That's 150,000. And you credit investment in equity securities kasi binenta na. So how do we value this one? That's 1,000 times 100. Again, where do we get 100? Diba? 1,200,000 divided by the new number of shares, the 12,000 pesos, 12,000 shares, sorry. So the new cost would be 100 per share. And since what we received is greater than what we parted with, we have a balance of 50,000, which is the gain on sale. If the share dividends come from a different class, for example, you own 10,000 ordinary shares valued at 800,000, but you receive a 10% stock dividend from preference share. So, magkaiba. Instead ng ordinary, yung natanggap mo is preference. The market value is 150 for the ordinary and 100 for the preference. So, how do we treat this one? Okay? So, this will be treated as a deduction from the cost of your ordinary shares. So we have to allocate this 800,000 to both the ordinary and the preference. So how do we do that? We get first the market value of the shares. So first is the original 10,000 shares. So 10,000 times 150. And then the preference is 1,000. How do we get the 1,000? That's 10% of 1,000. Okay? Sorry, 10% of 10,000. So that's 10,000 times 100. So the total market value for ordinary, 1,500,000. For preference, 100,000. Total is 1,600,000. So get the fraction. Okay, so that's remove the zeros, equal number of zeros and all the numbers. You will get 15 over 16 and then 1 over 16. So the allocated cost would be multiply these fractions to 800. So that's 800 times 15 over 16. You will get 750 and then 1 over 16 times 800,000. You will get 50. So what are we going to do next? So our journal entry would be investment in preference shares. That's a new investment, 50,000. And you credit investment in ordinary shares, 50,000. So as a result, your investment in ordinary shares now becomes 750 kasi nabawasan. And then it's transferred to the investment in preference shares. Okay? But if the share dividends are coming from investments in FVPL or FVOCI, there's a different accounting treatment. So assuming that the ABC company owns 10,000 shares in XYZ as investment in equity securities, and then ABC receives shares with fair value of 130,000 and par value of 100,000 as a share dividend. So in this case, there would be a journal entry. And as a general rule, we have to debit the investment and we credit unrealized gain. So it depends if it is FVPL or FVOCI in determining what would be the credit to unrealized gain. So first is if it is classified as FVPL, so we're going to debit held for trading securities and credit unrealized gain, profit or loss. If this is classified as FVOCI, then we debit investment in equity securities and credit unrealized gain OCI. There are also instances wherein what we expect to receive as dividend uh, based on the declaration of the dividends is not the same with what was actually received. So this happens when the investor chooses what type of dividend he or she is going to receive. For example, shares are received instead of cash dividends. So this happens when the investor opts to receive shares instead of the cash dividends. Remember that cash dividends are recognized as income. Okay? And meanwhile, share dividends are not recognized as income. However, since the original transaction is on cash dividends, this type of dividends, the shares in lieu of cash dividends, is recognized as dividend income equivalent to the fair value of the shares received. Okay? So, ulitin ko, dahil yung original na agreement or declaration is cash dividend, so ang dividend na ito is a dividend income. Even if yung matatanggap natin ay shares of stocks. And if this is the case, if the fair value of the shares are given, then the dividend income is equivalent to the fair value. But if there's no fair value available, then the dividend income is equal to the cash dividends that would have been recorded or received. Okay? So, for example, ABC Company holds 10,000 shares of XYZ as investment in equity securities. XYZ declares cash dividends of 8 pesos per share, but ABC chooses or opts to receive 1,000 shares instead. So, what would be the entry? So, first, if the investment is measured at FVOCI and the fair value is available. So, debit investment in equity securities, 10,000, which is equal to the 1,000 shares received times the fair value of 10 pesos. And then credit dividend income, 10,000 pesos. Again, ito ay dividend income dahil ang original declaration is cash dividend. If the investment is measured at cost, then debit investment in equity securities at cost, 8,000. So, why is it 8,000? Dahil walang fair value, we're going to use the cash dividends that would have been received, which is 8 pesos. 8 pesos times the 1,000 shares, and then you credit dividend income. Then, what if it is the other way around? Ang tinanggap natin ay cash instead of the share dividends. So, again, share dividend is not a dividend income. So, therefore, upon receipt of this cash dividends, we will not record any dividend income even if yung natanggap natin ay cash. Kasi yung original na declaration is share dividends, and again, share dividends are not treated as dividend income. So we will record this one using the as if approach. This means that the share dividends are assumed to be received and subsequently sold at the cash received. For example, the shareholder owns 10,000 shares costing 1,100,000. Then the shareholder receives 150,000 cash in lieu of the 1,000 shares originally declared as 10% stock dividend. So again, yung pinili is the cash instead of the shares. So what will be the journal entry using again the as if approach? So debit cash, as if nabenta yung shares. Credit investment in equity securities. And then that was equal to 1,000 shares times 100. And credit gain on investment, you have 50,000. So how do we get the 100 pesos? The original shares is 10,000 plus the 10% stock dividend supposedly. So there should have been 11,000 shares. And then 1,100,000, which is the original cost, divided by the new number of shares of 11,000. So that would be 100 pesos per share.